Rumour has it that Rachel Reeves is looking to cut the cash ISA limit from £20,000 annually to just £4,000, and this could happen as soon as 3 weeks' time in her spring statement. I'm going to show you how to get around this problem if it does come to pass with a method that you might not be aware of and how this clever product actually works. So as I said, the rumour is that the cash ISA limit could go down from £20,000 annually to just £4,000. What this means practically is that at the moment you can put up to £20,000 into a cash ISA account per year, and any money within that wrapper then becomes tax-free, which for the cash ISA in particular means the interest that you gain for having it in there. From the speculation so far, it sounds like any money that is already inside cash ISAs probably won't be touched in any way, so this should be limited to contributions in the future. But as with all government policy, these things can and do change. The current reason being given for reducing this limit is to encourage savers to move their money out of relatively low-yielding cash ISAs that barely beat inflation over the long term and into instruments that will more directly help the economy, for example stocks, so they say. Unfortunately, the advocates of this change are primarily city bosses and brokerages who have a clear conflict of interest in trying to tap the savings inside the cash ISA market and bring them over onto their platforms. Within this though, there is a good point. As per AJ Bell, £1,000 put into the cash ISA in 1999 would be worth just over £2,000 today. Although doubling your money sounds good, doing that over 26 years means that it barely kept up with inflation, depending on which metric you use. If invested into global stocks instead, this could have gained between 4.5 to 6 times depending on exactly where it was placed. This would have clearly been better for the saver in hindsight, but of course, as is usually the case in investing, it's a bit more complex than that. However, because this proposed cut is intended to target cash ISAs in particular, we are still very likely to be able to use the stocks and shares ISA limit instead at the full existing rate of £20,000 per year, which is very handy. The beauty of stocks and shares accounts in general is that it's not just limited to companies. These days we have a dizzying array of funds offering out all sorts of different return profiles, the most well known of which are the index funds, allowing us to bundle up hundreds and sometimes thousands of shares under one easy to trade wrapper. But some of the other more hidden variants give us pretty much what we're looking for from the cash ISA, but in the stocks and shares format instead. There are two in particular of interest to UK investors here, both of which broadly act very similarly to the cash ISA, and that is Lixor's Smart Overnight Return ETF and the Xtracker's Overnight Swap Rate ETF. This sounds a bit scary at first because finance people love to fill their product titles with important sounding jargon, so I'm going to bust a lot of that, explain exactly how they work and why they are practically very similar to the cash ISA. In essence, the objective of both of these funds is to track the SONIA rate. SONIA stands for Sterling Overnight Index Average and represents the average interest rate at which financial institutions lend to each other each day. Interestingly, SONIA has only been used widely across the financial industry for a couple of years. Previously, the main rate used for determining these things was LIBOR, the London Interbank Offered Rate, the name of which is now infamous because of the massive scandal that blew up around it in 2012. Unlike LIBOR, which relied on estimates submitted by banks who, as it turns out, yet again had conflicts of interest when reporting their rates, SONIA is based on real transactions instead, and so is much more robust. Within SONIA, the S for sterling means that it's the rate for pounds specifically, useful for UK investors because there's usually annoying foreign exchange fees for doing anything outside of our home currency in many accounts. And the overnight bit just means that it's measuring the interest rate for one single day's worth of borrowing. This effectively removes as much credit risk as possible from the rate, as a one-day loan is the shortest that can be made between two credit-worthy financial companies. So before we take a look at more of the technicals, let's have a glance at the practical side of the Lixor version. This one has the ticker CSH2 on the London Stock Exchange, and if we go and look at the historical price chart, it looks like this, a very smooth line. I mean, this is what we were looking for, right? The steepness of the chart represents the interest rate in each period of time, because Cash 2 is a physical security that you buy and sell that sits within a stocks and shares ISA, and not just an account like a cash ISA is. In the period from 2016 to 2020, the SONIA rate broadly sat between 0.2% and 0.7%, fell to just above zero in 2020 to 2022, and then rapidly climbed to over 5% between 2022 and 2023. This is matched in the price chart of our ETF, and with each day that passes, the SONIA rate for that particular day is added to the fund's price. For example, if the SONIA rate was 5%, this is an annualized rate for an entire year, so the price tomorrow would go up by 5% divided by 365 days, which is 0.014%. In the world of finance, because we're often dealing with small percentages like this, 0.014% would be referred to as 1.4 basis points, where a basis point is just 1/100%. It's a bit like the percent equivalent of pence and pounds. It simply makes it easier to talk about these small percentages without a bunch of zeros getting in the way. Often, people shorten down the phrase basis points to bips even because it's so commonly used. As you can imagine then, this is not really a lot. On a £20,000 position, you'd see a profit of £2.74 a day, but it's broadly the same as if you had it in a savings account at the same rate. One good question is why the price line is not perfectly smooth when we look at it on the chart. This is because the prices that you see on a service like Google Finance shows you the trading price if you're looking within a specific day, or the closing price at the end of the day when looking at historical data. This can differ from the theoretical price, which is known in the ETF world as NAV, or the net asset value, because the trading price of an ETF doesn't have to equal the theoretical price of the actual fund. Most of the time it will do broadly, because if these two things get out of line, then market participants such as market makers can conduct transactions themselves to close the spread, but there'll always be a bit of wiggle room around the net asset value due to people buying and selling the fund in real time. Because of the fact that ETFs do trade like a stock, it's important to pick one that does have actual liquidity, i.e. there are enough people buying and selling each day so as not to cause a problem with the process of actually trading the damn thing. The usual problem if there isn't enough liquidity is wider spreads. For an ETF such as this, where the actual profit per day is quite small, it's a bit more sensitive to wider bid and offer levels than something that can move 20 or 30%, for example, like an equity index. Just as an example, I checked the bid and offer prices of Cash 2 right now, and the last three digits are sat between 098 and 221. On the chart, this represents these lines here, so a sell order would go through immediately at this lower price and a buy order at this higher price. The overall gap in pricing here is 0.1% or 10 basis points, so when compared to the theoretical daily gains, it would take a couple of days to overcome before making any actual profit. The precise SONIA rate currently is around 4.45%, so this is 0.012% per day or 1.2 bips. In this specific case, you'd need to hold it for 8 days before a sell would break even, but just bear in mind that the bid-ask spread is not always the same. This doesn't include any trading commission either, which may well be applied by your brokerage. The average volume that we see on Google Finance for Cash 2 is 9,000 units a day, so it trades about £10 million daily, which is plenty for most people. Make sure you don't fall into the classic finance trap for UK listed securities, where most of them trade in pence rather than pounds, which is the case here. Each ETF unit of Cash 2 is worth around £1,100, not £101,000. This is represented by the indicator GBX here, probably because GB little p would look too similar to GB big P and might cause confusion. One of the biggest differences between Cash 2, the Lixor ETF, and the Xtrackers one, which is listed under the ticker XSTR, is how they pay out their gains, or more specifically, whether they do or not. It's clear to see from the Cash 2 price that the profit just rolls up inside the ETF. To actually get out your money, you have to sell out of your ETF position. XSTR is not like this. Instead, this one pays out an actual dividend like a stock would. You can see this obviously on the chart because XSTR goes up, and then there's a sudden drop as the dividend gets paid out of the fund. I personally prefer ETFs to do the reinvesting for me because it means that I don't have to go and manually allocate the cash somewhere, which is why I personally picked Cash 2, but it's up to you depending on your preference and what you need. One point that's worth mentioning is that there's been a bit of noise around Cash 2's upcoming corporate action because it is merging with another set of ETFs on the 7th of March. This is basically a lot of fluff to say that Lixor's ETFs of this series are merging with Amundi's, and effectively all that is going to happen is Cash 2 will stop trading on the 7th and reopen for trading on the 10th with exactly the same ticker, but just under a new fund name that says Amundi instead. The reason for this is that Amundi does actually own Lixor, the ETF provider, and they are consolidating the funds together. There's nothing more complicated than that as far as I can tell, and it won't even matter after the 10th. The one final question about these cash ETFs is how they actually work and how they provide you with the SONIA rate in the first place. These ETFs are referred to as synthetic, which is often a dirty word in retail finance depending on your viewpoint, simply because there is often a great preference for what is known as physical or full replication within the equity index world, which is typically where the retail investing base has the most knowledge. All physical versus synthetic replication means is it defines exactly how the fund derives the return that it's created to provide. For equity index ETFs, physical or full replication means buying all of the stocks in the underlying index and holding them directly within the fund. As the index level is calculated based on the performance of the shares that it contains, if you hold those shares in the correct quantities, then your return is the same as the index, which is what the ETF is trying to do. People like this because it is extremely transparent what is going on. The ETF is not reliant on any other financial counterparties to provide returns to you, and it just feels safer overall. There is a skepticism generally about financial engineering, which I think that's probably well placed, especially given the history of the finance industry, but for certain products an alternative method can be more appropriate. Cash 2, for example, to achieve SONIA physically would have to take the investor's money and lend it directly through purchasing short-dated government bonds and other instruments that provide the return that the fund is looking to achieve. This is in fact how traditional money market funds do work, but Cash 2 is a money market fund equivalent, meaning that it isn't technically a money market fund at all, it's just an ETF that targets the returns of SONIA. Using these other various instruments mean that a money market fund won't necessarily precisely match the benchmark that it's looking for, and that's what tracking error tries to represent. Cash 2 doesn't work like this though. According to the website, in order to achieve its goals of achieving SONIA for the investors, the fund actively manages and invests in a diversified portfolio of financial instruments and repurchasing agreements in an environment of strict risk and liquidity monitoring. This basically tells us absolutely nothing about what it's actually doing. What is more insightful though is looking through the holdings of the fund, which can be downloaded in an Excel spreadsheet, and looking at what the fund actually contains, you might be surprised to find that it is full of stocks, and mostly stocks from the USA. This might look very, very strange at first glance for a fund whose objective is to return SONIA to the investors, but how this actually functions is the fund uses the cash given to it to purchase these shares, and at the same time it enters into a transaction called a derivative with an investment bank called a total return swap. Without spending another 20 minutes explaining exactly how this functions, and maybe I will do in the future, effectively what this setup does is it takes the returns of the stocks that are held by the ETF and gives them to the investment bank through this agreement. And importantly, this works both ways. So if the shares go up, the fund pays that return to the investment bank, but if the shares go down, then the investment bank pays the fund. This means that the fund itself actually has no exposure to the price of the stocks themselves and is entirely impartial as to whether the stocks go up or down on a day-to-day basis. However, what the fund has done is purchase stocks using cash and is now providing the returns of those stocks to somebody else who didn't have to buy them. Because cash is a valuable resource, this arrangement requires the fund to charge interest on the cash that they have had to deploy, and in this case, the investment bank then pays them SONIA for the privilege. This is how SONIA gets produced by the fund, and part of the 0.1% cost associated with the ETF annually accounts for the fact that the fund won't get exactly SONIA, but a little bit less due to the fee from the investment bank for this arrangement. So now that we know how it works, you can hold this knowledge in your back pocket in case something changes with the cash ISA limit. But remember, these products don't usually hold up well against inflation in the long term, so to actually stand a good chance of increasing your wealth, go and check out this video on index investing and why it's my preferred method to allocate cash for longer than 10-year horizons.